Hello everyone, I'm Julia Hartman from the Bantax National Accountants Group. Thank you for joining us, and I'm hoping you will find this very informative. Each member of the Bantax Group is presenting a particular topic to do with the coronavirus stimulus. There's also a blog on the topic on our blog page and probably on the page you got to this link from. Now, that blog will be updated regularly. Unfortunately, even the legislation that came through yesterday, we thought it was going to tell us how the JobKeeper payment was going to work, and really all it said was that it was giving permission to Treasury to make rules regarding the JobKeeper payment, and we haven't got those rules yet. But we do have some fact sheets. We've tried our best to give you the most reliable information available. You need to have it now, so we need to get it out to you. And please keep in touch, keep reading the updates to the blogs, and consider that this information is only general in nature. Now, to start up with, we'll have Lynn Gower from our Gold Coast office, who's going to talk to you about how the various stimulus packages affect individuals.
Hi everyone, my topic is the stimulus for individuals and what is available to you. So if you're receiving a social security payment, you can expect to see an extra $7.50 in your bank sometime in the first 2 weeks in April. And in fact, some people have already received their first payment. There's another one also due on 13th of July. There is an exception to the 13th of July payment if you receive the extra $5.50 per fortnight coronavirus supplement. The coronavirus supplement will be paid from the 27th of April to recipients of job seeker payment, partner allowance, widow allowance, sickness allowance and wife pension, youth allowance for job seekers, youth allowance for students and apprentices, Austudy for students and apprentices, Abstudy for students getting living allowance, parenting payment, partnered and single, farm household allowance and special benefit. The $7.50 payment is tax-free, which is great, and applicable to a whole host of payments from Social Security, including age pension, disability support pension, and there's a whole list that will be on the blog. Other good news is the waiting period has been removed for sickness benefit when a casual employee is required to self-isolate or contracts the virus. Job seeker payment has replaced New Start. There's an income test, but the asset test is waived, and sole traders and casual workers qualify for this payment. Your spouse's income will be taken into account only if it exceeds $80,000. Sole traders will be able to continue to work in their business rather than to look for work. So this is really like a farm subsidy. Keeps your basic bills paid while you still keep your business doors open. If you make your living from renting out your property on Airbnb, your income is probably now zero and you could be classed as a sole trader. Even though you might have many properties as assets, you should still qualify for this immediate payment of $5.50 per week. Individuals experiencing hardship will now be permitted to draw $10,000 this financial year and $10,000 next financial year from their superannuation. Normally hardship payments are heavily taxed, but these drawdowns will be tax-free regardless of your age. To be eligible to access your super, you need to meet the following requirements. 1, you're unemployed or you're eligible to receive job seeker payment, youth allowance for job seekers, parenting payment, partnered and single, special benefit or farm household allowance, or on or after the 1st of January 2020, you were made redundant or your working hours were reduced by 20% or more, or if you're a sole trader, your business was suspended or there was a reduction in your turnover of 20% or more. Timing is important here as the concessions start on the 20th of April and stop on the 24th of September. And you only get one pick at the cherry each financial year. So if you only withdraw $5,000 in the 2019-20 year, you can still only withdraw $10,000 in the financial year ending 2021. Effectively, your maximum threshold is $15,000 instead of $20,000. There's a link on the blog which will show you where to go to have a look at those early release conditions. And you can actually register your interest on MyGov as well now. For retirees, the minimum amount you are required to draw from super for 2020 and 2021 financial years will be halved. If you're receiving a part pension, the deeming rates will also be reduced from the 1st of May 2020. The lower rates will be 0.25% and the upper rate 2.25%. This means unless you're on the maximum pension, expect an increase in your fortnightly payments.
We're moving along to the business section now of the coronavirus stimulus package, and Shelley Kutch from our Mackay office is going to talk to you about the JobKeeper payment. Thank you, Shelley.
Hi everyone, I'm Shelley Kutch from the Mackay office in Queensland. So I'll be chatting to you about the JobKeeper payment and what it can or can't mean for you. So the JobKeeper payment, essentially the purpose of this is to assist employers affected by the coronavirus pandemic to continue to pay their workers. Now, in order for them to be eligible, they have to prove that if they have reduced their turnover by more than 30% if they're a small business, and more than 50% if they're a large business. The difference between a small business and a not small business is a $1 billion turnover. So if your turnover is less than $1 billion, you have to prove that you've reduced your turnover by 30%. So that makes the employer eligible. Then they can make this payment onto their eligible employees. So what makes an employee eligible is they have to have been employed on a full-time or part-time capacity on the 1st of March. And if they're employed on a casual basis, they have to have been employed by 12 months by the 1st of March. They also have to be more than 16 years of age, and they have to be an Australian citizen or the holder of a permanent visa. Temporary residents, unfortunately, do not qualify, with the exception of New Zealanders on the 444 visa. In addition to that, an employee can only receive one JobKeeper payment. So if they're receiving the JobKeeper payment from another employer, they are not eligible for your employment to receive this. A good way that you can have a look at this is to look at their TFN declaration and see if they've ticked on the tax withholding bracket. If they've ticked that on their TFN declaration, then you can be pretty sure that you are their primary employer, and therefore they are probably only applying for the job seeker through you. So please understand that the JobKeeper payment can only be made through the employer. So unfortunately, individuals cannot apply for this in their individual capacity unless they're a sole trader or partnership, which we will get to later. So what happens now is the employer has determined that they're eligible and that they have eligible employees. So what next? Now you have to register with the ATO to show that you want to be registered to receive this JobKeeper payment. Now the link to do that is on the blog, so please follow that link, but it is on the ATO website as well. So you need to register with the ATO that you want to receive the JobKeeper payment. Then you also have to register your monthly income compared to 12 months prior. The JobKeeper payment will be paid to employers for a period of 6 months that they qualify for this. So the good news is for the employers, it comes in and it goes out through wages. So it's an in and an out, and you won't have any tax implications on this. For the employees, it is taxable income. It will be shown as taxable income. So please be aware of this. Employers, you still have to withhold PAYG on this, just as you would their normal wage. Now, what about super? You probably have not been paying your employees exactly $1,500 a fortnight. So what does that mean compared to the employees that you had on your books? If you were paying your employee $1,500 a fortnight, easy. It's in and it's out through your payroll, and you're withholding the same super that you ordinarily would have. If you are paying them more than $1,500, you have to continue to pay them what you normally would have paid them, and the $1,500 a fortnight will subsidize that payment. The super guarantee that you pay on those wages will be based on the wage that you would have ordinarily paid that employee. If you had paid your employee less than $1,500 a fortnight, your super that you pay on that only needs to be based on 9.5% of what you were previously paying your employee. However, you have to pay them the full $1,500 in gross wages. You receive the full $1,500 from the ATO, you have to pay them that full $1,500 in gross wages, even though your super only is based on what they were receiving previously. If you have previously stood down your employee, things haven't been going well on 1st of March 2020, and since then you have stood down your employee, you do have the option to take them back and pay them through the JobKeeper. However, if you're not actually taking them back into your employment, in that they are not coming back and working for you, you don't have to pay them any super. But if they do come back and physically work for you, you have to pay them super based on the time that they are working for you. Remember, you pay them the $1,500 minimum per fortnight, but the super would have been based on, if it's lower, based on that amount, and it's the employer's prerogative whether they wish to pay them more, but they don't have to. They can cap it at whatever they were receiving or they were paying their employee prior to standing them down. Right, so what about the hidden nasties? Please bear in mind that while this is a great initiative to continue having employees working for you and paying those employees, and it is a great stimulus that has been offered, please be aware that the ATO are making these payments a month in arrears, which means as an employer, you are going to be out of pocket for a month's worth of wages. This can be quite significant, especially if your industry is no longer making any income. You still have to pay super on those wages based on what we've just discussed. But if they're in your employment, you still have to pay them super. They also accrue leave if they're on the JobKeeper payment, as well as you may also incur payroll tax obligations and work cover premiums. Finally, be aware that there is also a lot of admin involved. You will have to pay these employees through your books, so you're going to have to withhold PAYG, attend to the super based on what we've just discussed, as well as report to the ATO on a monthly basis. So there is administration involved. Either you'll be doing that or your accountant will be doing that. So there are costs involved in doing that. The final thing to consider is, while we would hope that a lot of employees are being honest and upfront about it, there is a possibility that they may try and abuse the system and receive a JobKeeper payment from more than one employer. Now, the problem with that is because the ATO is paying you a month in arrears, chances are this employee may receive a JobKeeper payment from more than one employer, and by the time the ATO figures that out, you're the one that's out of pocket, not them. So, and it's unlikely that you'll get that amount refunded. So it's something that you really want to consider. One, is this a good quality worker that you really want to retain? And do you have the trust in them that they're not going to be receiving it from somebody else? There are other things to consider. For example, what if your business hasn't been operating for 12 months and you can't compare it to 12 months previously, but you have significantly decreased your income? Unfortunately, the legislation has not dealt with that up front. What they have said is that they're leaving that up to the Treasury. So what you would probably have to do is apply to the Treasury for a special consideration that you have not been operating for more than 12 months. Now, this is not only offered to businesses or to people with employees. This is actually also offered to sole traders and partnerships. However, you can only have one person who is the JobKeeper recipient of this, which is fine in the case of a sole trader. If you have a sole trader business that's decreased 30% compared to the same period last year, you can apply for this JobKeeper payment, nominate yourself as the primary JobKeeper recipient, and you will receive this directly. Just please remember again, this is taxable income, so it will be shown as taxable income. So if you're a sole trader, you want to be putting a bit of money aside for that because you will be taxed on it. If you're a partnership, unfortunately, you can only allocate one person to be the recipient of this JobKeeper payment. So you will have to have that discussion between the partners to determine who's going to be the nominated recipient. It's the same with trusts who were receiving a trust distribution, or directors of a company who previously just received a dividend and did not receive a wage. The ATO is going to be looking out for people suddenly receiving wages, so be aware of that, but you can nominate someone for a JobKeeper payment in these situations, as long as you can prove that the business is eligible because their revenue has decreased by more than 30%. Right, so I think that's everything from me. Please just be aware of the hidden nasties. And like I say, it's a great initiative if you've got good quality workers that you want to retain and you don't have the income at the moment to retain. But just be aware that there is that month lag that you are going to be out of pocket for, and there are other accruals that you will have to take into account, such as super, payroll tax, leave entitlements, and the additional administration. Thanks, Julia.
Thank you, Shelley. I certainly hope everyone got that message that you need to talk to your accountant. It's not as simple as just sign up and register, because there's pitfalls. Thank you so much for that. Well, while we were busy making this webinar on Thursday, Treasury was busy introducing more rules for the JobKeeper payment. We now have a lot more detail on how the concepts explained by Shelley would work. Thanks to Cooper, our editor, for seamlessly cutting this segment into the webinar over Easter. The JobKeeper payment best suits a business that thinks it might trade through okay, but doesn't want to risk it. That is, incurring all those wages and then the sales don't come in. The business owner may be thinking, better to close now and break even than get further into debt. This is where the government is saying, keep going. If your trade drops by 30%, we will subsidise your wages, hopefully to the extent that even with a lower turnover, you will still make a profit, and we will even subsidise your own wage. In this regard, it is a great idea, encouraging businesses to keep on trying. But it is not such a good idea to pay staff if you have stood them down and will continue to stand them down. Consider all the additional costs that Shelley mentioned. There is also a twist in the rules that will actually force you to sack staff you have stood down if you want to continue to reduce staff while receiving some JobKeeper payments. You see, to qualify for JobKeeper payment, you must apply it to all eligible staff, even those ones you have stood down. An employer may be entitled to JobKeeper payment for themselves. So anyone with a turnover drop of 30% or more would be lining up for that. But be careful, if you have staff that you have stood down, all eligible employees must be paid that JobKeeper payment. So you're either going to have to sack those that have been stood down or take on responsibilities for paying them. To quote the explanatory memorandum from the Treasurer, this is word for word, this includes all eligible employees who are undertaking work for the employer or have been stood down. The employer cannot elect which eligible employees will participate in the scheme. This one in, all in rule is a key feature to the scheme. This forces people to sack staff they have stood down and sack staff in order to qualify for the payment for themselves as an employer, for example, a sole trader, or to be able to only pay key staff, they have to sack the rest of the staff. After all, if they have no work for the other staff, why would they go through all the costs and the risk of not getting paid and processing the pays for them on JobKeeper? The employer would also have to weigh up sacking and paying out leave entitlements compared with standing them down and letting them continue to accrue leave entitlements during this period. So yes, you might have to pay them out their leave entitlements because you've sacked them rather than just stood them down. But while they're stood down, they're accruing leave entitlements, and this could go on for 6 months. If you can only afford to keep a few due to a drop in your turnover, then you really have no choice but to actually sack the rest or take the risk. You will have to pay them $1,500 a fortnight for doing nothing and then find the ATO decides you don't qualify. Further details provided in the statement are that to receive JobKeeper payment for an employee, they must provide you with a notice that they agree to nominate you as their employer, that they haven't given such a notice to another employer, and that they do not have permanent employment with another employer if they were only employed casually with you. If the employee is not honest with you in this declaration, the ATO can make both the employer and the employee liable to repay the JobKeeper payment. But the reality is the employer is going to be the easiest target for the ATO. Now, each pay fortnight begins on a Monday, starting with Monday the 30th of March 2020. So that's the start of the pay period, not the end of it. And that goes on for 13 fortnights. The employer must have already paid the wage before they get paid by the ATO. From May, this has to be reported to the ATO each fortnight, probably through single touch payroll. The statement even goes as far as to say that from May onwards, if you have not reported by the last day of the fortnight, you will miss out on that payment. Now, this is a very scary rule because of the time constraints created by an unreliable ATO website, the fact that a lot of people now will be switching to single touch payroll quickly so that they can report, and they're not used to using the software, they'll make mistakes, they'll have trouble getting it to work, and they've got this deadline looming, click past midnight I gather, and you don't get, well, $1,500 for each one of your employees. Again, risk, risk, risk. For April, you're allowed to report both fortnights at the same time towards the end of the month, which is just as well because it's not all up there yet. There is a concession for employers who normally pay monthly to apportion their payment over 2 periods. Now, to measuring the 30% drop in turnover. With the exception of unusual circumstances, it is comparing a month or a quarter in 2019 against the same month or quarter in 2020. The test is a forecast unless you use March 2020 or April 2020, because you will have those figures. The earliest month you can compare is March 2020 if you choose to measure monthly turnover. Alternatively, you can use quarterly turnover starting with April and to June quarter. From May onwards, if you haven't already qualified you have to self-assess whether your turnover has dropped enough to qualify in the first fortnight of the relevant month. So you're 2 weeks into the month if you're lucky, not even there, and you've got to predict how the rest of the month is going. That happens after May. Because you don't have to report until the end of April, you've got a bit more leniency in April, and obviously March already has happened. But you've got to choose that month, and March mightn't have had much of a drop. In April, you only have to make your forecast by the second fortnight. If you are out a little, You may not have to pay it back if you can show you had a reasonable method of estimation. Examples given are a lack of quotes in a previous month, so you've assumed it was going to be down the next month. If your business has been forced to close, it's not a problem. Obviously, your turnover has dropped. Otherwise, you need to consider that you may well get to the end of the month and not qualify, which is fine if you didn't commit yourself to paying wages that you couldn't afford on a 29% drop of turnover. But the idea I have heard of getting staff in just to sweep the floor might not go if they are not contributing to turnover, as it might turn out that you may be better to completely sack them right from the start, because you might not be reimbursed for their wages if your turnover drops only 29%, 27 or whatever. The Treasurer's explanatory statement says that the turnover for GST purpose is what they will use, but it does not include input tax, supplies or sale of capital items. It is implied that they will use information from the BAS to check your turnover, but that has a whole lot of problems. There's no guidance on how that will work if you are just going to apply the 30% test to 1 month, yet you report your income on your BAS quarterly. Further, there is no guidance as to whether it will be on a cash or accruals basis. One would think that if they're going to compare the period in the previous year, it will have to be on the same basis as you're reporting your BAS. But of course, businesses that issue invoices after work is completed or run accounts, well, their cash received in 1 month is more likely to reflect the previous month, so they put a month behind. The good news is that once you obtain the qualifying 30% drop in turnover, you are entitled to stay in the JobKeeper program for the duration of even if your turnover comes back up. If you don't qualify in April, you can test again in May and so on. But you can't get paid for the previous month if you hadn't got into the system by then, because you hadn't had a 30% drop yet. Only goes forward. Employers are not completely locked in. They can withdraw from the scheme. This might be the case if the employer decides just to let their staff go rather than continue with all the job seeker requirements. Warning. Now, the ATO has the option. It's not automatically going to happen, but they do have the option to take the JobKeeper payment they were going to pay the employer and offset it against other tax debts of the employer. So you might not actually get it. Next up, we have the immediate write-off for plant and equipment under $150,000 and the 50% accelerated depreciation on plant and equipment. There's a lot more to this than meets the eye too. Tanya Reid from our Mackay office is going to talk to you about that. Thank you, Tanya.
Hi, my name's Tanya Reid from the Bantax Mackay office in Queensland. I'll be discussing today the immediate asset write-off and the 50% asset write-off that's come a part of the government's new stimulus package as a result of COVID-19. I will be reading from a script because there is quite a bit of information involved, and I want to ensure that we're not missing anything that we need to cover. There are some slight differences depending whether your turnover is under 10 million or under 500 million. The basic concession is to allow small to medium businesses to immediately write off purchases of equipment costing less than $150,000, as long as it is installed and ready for use by 30th of June 2020. Like items do not have to be added together to be tested against the $150,000 threshold, so you could effectively buy $10,000, $20,000 vending machines. The equipment can be new or second-hand and is also available for improvements to existing assets. It is important to note that the immediate asset write-off threshold reduces to $1,000 from the 1st of July 2020, and then is only available for businesses with turnover of under 10 million. So that installed ready for use deadline is crucial. Asset purchases that definitely do not qualify are horticultural plants and building construction. If you're financing the purchase, do not use a lease. It must be a loan so that you actually own the asset. For all the fine print, refer to our blog on immediate asset write-off, which is based on the original legislation with the figures and dates updated. It will be provided at the end of this session. Most importantly, you need to speak with your accountant before you rush out and spend a lot of money when we are talking about such big sums. An immediate deduction might end up being more than your taxable income for the year, wasting your tax-free threshold and lower tax brackets. The net result could be better, if the asset cost was actually depreciated over several years. But if you install it ready for use between 12th of March and 30th of June 2020, you will have no choice but to claim it. Now, here is the fine print depending on the size of your business last financial year. For turnovers under 10 million, which would apply to most of our client base, you're already allowed this write-off for anything you bought this year that cost less than $30,000, providing, of course, it is installed ready for use by the 30th of June 2020. This threshold is increased to $150,000 if the equipment is installed ready for use between 12th of March and 30th of June 2020, even if you ordered it or paid for it earlier. That's right, there might be a few factory owners thanking their electricians for being tardy. You could have even ordered the equipment as far back as 12th of May 2015. This concession extends to allowing small business pools under $150,000 at 1st of July 2019 to be written off. This is a trap for small businesses that do not have huge profits this year. The write-off of their pools is compulsory, so all small businesses will lose their pool balance if it is under $150,000. The formula is start with the balance as at 30th of June 2019, add business share of new assets. This is probably zero as it would have already been immediately written off, so bypass the pool. Subtract the business share of the proceeds of any pool assets sold during the year. Note this balance is calculated before applying depreciation for the 2019-2020 year. If the asset is purchased by a holding entity that just leases back to its trading entity, it will not qualify for the concessions because it is not in business. Okay, the next threshold is turnover over 10 million but under 500 million. You are only entitled to the 150,000 immediate write-off if you actually ordered or acquired the equipment after 2nd of April 2019, but it was installed ready for use between 12th of March 2020 and 30th of June 2020. If the asset is purchased by a holding entity that just leases back to its trading entity, it appears because of the sheer size of the turnover that would be considered to be in business so it can access the concession. Further, if the entity has turnover of more than $10 million, these concessions can apply to plant and equipment in a commercial building that is passively rented out. It's an interesting point. The next topic I will be discussing is the 50% asset write-off. But wait, there is more. And this goes through to 30th of June 2021. First used or installed ready for use. It only applies to brand new plant and equipment, not buildings. This applies to businesses with a turnover of under 500 million. The exclusions are buildings, horticultural plants, water facilities, fencing, and fodder storage costs for primary production. Also excluded are items your employees' salary sacrifices. You must not have committed to the purchase of the asset before 12th of March 2020, and it will not help to cancel a contract and reorder. This is something that is called out. This is probably only of interest to businesses after 30th of June 2020, otherwise they would be using the immediate asset write-off. That is, unless they intend buying equipment worth more than $150,000, then the 50% write-off is the only option available. The measure provides an immediate deduction for 50% of the purchase price and installation cost. Then the remaining 50% is written off in accordance with normal depreciation rates. This depreciation starts in the year of purchase, so you get the 50% deduction plus some depreciation. If the asset is placed in a small business pool, then the write-off and depreciation for the year will total 57.5%. Now, I understand there's a lot to take in, so please ensure that you do discuss any of these issues with your accountant. Thank you, Julia.
Well, that was great. Thank you, Tanya. Next up, we're talking about this concessions of up to $100,000 if you employ people and pay wages tax. And the good news is that even if you don't pay wages tax, but you at least employ someone, you get a minimum payment. But to tell you all the details on that is Jane Hadrill from our Canberra office. Over to you, Jane.
Thanks so much, Julia. Yes, so Jane Hadrill, I'm in the Canberra Bantax office, and I've got many small business who are really suffering through this time at the moment. And the stimulus package which has been offered by the government has been gratefully received. And it's been really helpful to be able to talk to the other band tax officers to find out the ins and outs and the pitfalls of them. So I wanted to start though by talking about the ACT Economic Survival Package, as they're calling it. And first of all, they're offering various industries, such as food businesses and beauty therapists. Their registration can be waived for 12 months. So that's, a good start, and fair enough too. If you're a tattooist and you can't open your tattoo parlour, why should you pay the registration fees? Payroll tax is going to be waived for 6 months for businesses directly affected by COVID, such as gyms, beauty therapists and nail salons. So I think that's a pretty big gesture. And then payroll tax liabilities for other businesses will be deferred until the 1st of July 2022 and no interest paid. No interest will accrue. So 2 good offers, I think. Small businesses with electricity usage less than 100 megawatts per annum will get a $750 rebate applied to their next electricity bill. And the first I knew about that was when a client rang me and said, hey, I got a lower electricity bill. And I'm like, oh, I need to find out about that really, don't I? And then the last one is for commercial landlords, their rates will reduce by $2,622 in the 4th quarter. So I think I'm certainly saying to my clients who have got commercial leases, they should be saying, hey, I'm sure you can do a bit better than reduce my rent a bit more, because we know that you're getting the 2,622 off your next bill. So that's what ACT is offering. In terms of this cash flow assistance for businesses, I think personally it's one of the cleanest way that the government is offering relief to small business, because it's not able to be disputed and there's no decision to be made, unlike the JobKeeper payment that Shelley talked about, where you have to decide whether you do want to keep someone on or pay them JobKeeper or what. Everyone gets this if they employ staff. So if you are a small or medium-sized business and a not-for-profit entity, and you have turnover of less than $50 million, that's certainly all of my clients, probably all of my clients combined, I have to say, and they employ people, they'll be eligible to receive a total payment of up to $100,000 between now and October. And this is based on their pay-as-you-go withholding obligations. So the stage 1 credit happens prior to 30 June 2020. So when the March BAS is lodged, so by end of April, eligible employers that withhold pay-as-you-go withholding will receive a tax-free payment equal to 100% of the amount withheld, up to a maximum of $50,000. So you lodge your March BAS, you're recording wages and pay-as-you-go withholding for January, February, March. You've got $20,000 in pay-as-you-go withholding payable, and hey presto, you don't have to pay that $20,000. Now, if your GST for that quarter was $15,000, you would actually get a refund of $5,000. So this is really practical help that the government is offering. If you're a monthly lodger, it's a little more complex. Because you've already lodged your January, February instalment, what they're saying is that when you lodge your March instalment, they're going to multiply it by 3 and say that's what would have been for your 3 quarters. So if you lodge on the March BAS $15,000, they're going to assume that it would have been 15 for January, 15 for February. So they're going to give you a credit of $45,000. So this is going to be a really good cash flow boost, particularly if you're only paying GST on a quarterly basis. It's really going to help you out. So it should be noted that even if you don't pay any pay-as-you-go withholding tax, as long as on that March BAS you have a figure at W1 that you've paid wages, you will get a minimum $10,000. Now, if you don't pay GST, you'll get the full $10,000 as a refund into your bank account. This is really going to help people along the way. So that's what's going to happen up until June 2020. You can't exceed the $50,000 credit. And if you're paying no pay-as-you-go withholding, you can't exceed the $10,000. But stage 2 is actually much simpler. So as soon as you lodge your June BAS, you're going to get 50% of what you received in the first half of the year. So if you withheld $50,000 and then you got a $50,000 credit, in July, assuming your ABN is active, we're not even certain that you have to continue to be employing people, but I wouldn't be deregistering from pay-as-you-go withholding if I were you, then what we're hearing is that you'll get a $25,000 credit from that BAS, even though it has no relation to what you've actually included in that BAS as W2 pay-as-you-go withholding. If you got the minimum $10,000, you will get $5,000 in July. The next payment will come in October after you lodge your September payment. 50%, if you got $50,000 in the first half of the year, you'll get $25,000 in October. And if you got $10,000 in the first half of the year, you'll get $5,000. So it really is an opportunity that the government's giving business to really help them out. And it should be noted that there's no expectation that this money will be used for wages. It is that stimulus package to put it back into the business, and you use it for what you need to use it for to keep your business going and to survive.
Thank you, Jane. That was great. And of course, it brings to mind, what's the catch? How, what rules have they got in place to stop it being exploited? And that's the next topic we're going to cover. So thank you, Jane. Jane from our Canberra office. Now, our next speaker is going to be Cathy Jones, and she's the practitioner at both our Ningi and Caboolture offices, and she's going to talk to us about all the anti-avoidance rules.
Hi, I'm Cathy, and I run the Ningi and Caboolture offices, and I'm going to talk about some rorting and some scheming. Okay, so we've heard lots of information about lots of money that the government is giving away. So naturally, everyone wants a piece of it. Everyone wants what their fair share is, and which is only understandable given the economic climate and everything. However, there are integrity measures that the government has put in place to ensure that it is a fair system and that there is money for everyone for later on, sort of thing. Some of the things that the government has put in place, there are penalties, particularly for taxpayers and also for tax agents. So particularly with tax agents, we only have to answer to the taxation ATO, but to our taxation practitioners board. So we do have a lot of pressure on us to ensure that we are doing the correct thing, which we always do, but to make sure that lots of agents are doing the correct thing. Yeah. So some of the things, so you might be saying, well, what's a scheme, what's a rort? There's a few things that have to be in place for any of these, particularly the cash flow economic boost to happen. You have to have had a business, an ABN number on the 12th of March 2020. So you can't just go out and create a business, start paying wages and think you're going to get entitled to some of these benefits. So the business must have been operating by the 12th of March. It also needs to have derived assessable income from carrying on a business in the 18-19 income year. Now, you can either show this by having lodged your tax return or lodging activity statements since the 1st of July 2018. You may be, if you haven't lodged your tax return, if you're on a lodgement list, this should still be able to be taken into account. The explanatory memorandum also requires that the entity has not engaged in a scheme or the sole purpose of seeking to make the entity entitled to cash flow boosts and increasing those entitlements. So the ATO has prompted a few things by saying you can't restructure your business suddenly, sort of thing. You can't restructure the way you would normally pay your workers. You can't sort of increase your wages in a particular month just to maximise these cash flow boost payments. So what they'll be looking at is what you would normally be doing to see if there's any diversion from those facts. Now that doesn't mean that you can't do things, because in any business there's always something that comes up. You might have started employing a person legitimately, sort of thing. Your business is going really well, and there are businesses that are going really well at the moment, sort of thing. And you want to put them on as wages, you're entitled to do that. You might also be having a business that has been doing really well. You might not have been drawing wages from it in the past, but now you might have used up all those carry forward losses. You've now got profit in the business, so you're now able to take wages out of the business. So as long as you've got legitimate reasons for doing what you're doing, we don't believe there should be any issues. Now you need to back that up by making sure that you're doing things properly. So you need tax file declarations. You need to enrol in the single touch payroll system. You need to make sure that you're paying superannuation for your employees. So all those things add and show that what you're doing is legitimate. So if you're not doing any of those things and you suddenly pay $50,000 in wages with a huge tax bill in the Q3 and then nothing for future, then yes, that's going to draw the attention of the tax office. So once again, we believe that as long as you're doing things legitimately, you should be fine. A lot of things, there also might be the temptation to put everything into this Q3 BAS, purely because we need the money, we want the money, we have to have the money now, sort of thing. But normally it might be your accountant that does things in the Q4 activity statement. If you bring those forward, those things forward, then you're probably running a risk. So it's best to keep things happening as they would normally happen. You know, bring those wages into the Q4 activity statement when your accountant would normally do those things. What about family members that are working in the business? They do work in the business and they do get paid for doing things. So now, and they want a share of the profits. You may not have been doing that in the past, and there's that temptation to put people on to wages to do that sort of thing. Once again, you've got to make sure there's legitimate reasons for doing it. You might now be in that position that you can start to pay wages and start to pay superannuation, and you want to do things properly, sort of thing. And that can be a legitimate reason for doing it, sort of thing. Is it a scheme? Is it the dominant purpose for qualifying for the bonus? We don't think so, because we're doing things legitimately, sort of thing. As long as you've got a legitimate reason for doing it, we believe you're okay. There is always a risk that the ATO may come along and say you're just doing that for the dominant purpose. So as long as that's where you're backing yourself up by what you're doing, sort of thing. And, you know, make sure you've talked to your accountant. You know, make sure you've looked at your profit for the year. Make sure there is enough profit in there to pay yourself a wage. All those things. For the JobKeeper payments, we believe there's similar anti-rort rules in process, in place. They look to make sure that you're not doing it for the dominant purpose to obtain or increase the JobKeeper payments. One of the things might be that instead of paying yourself a wage, you might be legitimately entitled to take the JobKeeper payment, particularly if you're a director of a company or a beneficiary of a trust. So rather than risk the ATO looking at you when you're just declaring wages, then maybe the JobKeeper payment is an alternative. And it's also just important to remember that it is a criminal offence to make false and misleading or reckless statements. So we don't want to make sure that you're doing those things. Yep, so seek your accountant's advice before you do any of these things.
Thank you, Cathy. It's a real dilemma, isn't it? Because it's against the law if you pay someone a wage not to declare that,
Yes.
you know, you've paid the wage. So you can't win either way. You just got to make sure they really did work. And yeah. But anyway, thank you very much for that. That's great. I would now like to introduce James Wood from our Toowoomba office. He's going to talk about some of the ways this can apply to businesses where they're actually property investors.
Hello. In the next few minutes, I will briefly outline issues that I recommend be considered by landlords who have tenants who are impacted by the changes and circumstances due to the coronavirus pandemic. On a daily basis, you'll be hearing from the government and related agencies about various proposals for action. I understand how confusing this can be. Rest assured, we're all in the same boat at the moment. What we do know is that the government has put in place a moratorium on evicting tenants for 6 months, and that really is the key issue at this time. That is, in fact, the only definitive thing we know about at this point in time. However, there are some related strategies for landlords to navigate this. Now, the Property Investors Council of Australia, in a nutshell, suggests that landlords should hold off reducing rents until the government releases more detail. Why? Because it may potentially reduce a landlord's claim if there's a tenancy relief package. Another potential issue to be aware of in relation to reducing rent is that by doing so, it may also impact on the landlord's ability to make a claim on the landlord's insurance should a tenant default on their rental obligations. A second strategy for a landlord to consider is the bank's offering of a mortgage payment pause. However, I would urge some caution with this. In other words, what I'm saying is that is something that you would do as a last resort, because long term this may lead you in a worse position financially as the obligations to repay the interest and capital are only being postponed. Finally, I'd suggest the landlord do some modelling with cash flow budgets with your accountant, of course, can help you. So you're fully informed of the implications adopting each of the proposed strategies. In closing, the key message is don't make any snap decisions about reducing rent until more is definitively known. Stay safe, everyone. Thank you.
Thank you, James. Next up, we're going to talk about the additional assistance for people with apprentices and with trainees. Leah Supple from our Melbourne office will give you all the details on that. Thank you, Leah.
Thanks, Julia. First, I just wanted to touch on two things that the government in Victoria are doing. Anybody that has wages of less than $3 million, their payroll tax is being waived for the year. So you can apply online to have your payroll tax that you might have already paid refunded, and that happens within a few days that you'll have that money back in your account. The other one is that there's a grant that the state government have available. It's for $10,000. The application's really easy online. If you're in hospitality or tourism, I'm not saying it's a guaranteed 10,000, but it happens really quickly and you'll get notified within probably 24 to 48 hours if your application's been successful, and the money will be in your account within a week. So the one thing you do need is to attach a copy of your business activity statement and anything else that you feel might help them make a decision. So I do encourage anyone in Victoria that's running a business to apply for that grant, because I think it's a really good one. Some of our local government, like local councils, also have grants. So the City of Melbourne, they also have a really good grants program. It's a little bit more detailed, their grants program. They require a little bit more information, but I do urge you to go and have a look at each of the local councils maybe in your area to see what they're offering. But today I'm going to talk about the apprenticeship and traineeship rebate that is happening. Now, some of you might think, well, if your business qualifies for JobKeeper, do I qualify for the 50% of your apprentice's salary? And the short answer is no. So you must choose one or the other. It's probably, I would say, a no-brainer to have the JobKeeper. But for all businesses that might not qualify for JobKeeper, then the 50% apprentice and traineeship rebate is running for 9 months. So if anyone that's got an apprentice probably would have received an email by now from either the apprenticeship support network or the trainee entity that is managing your apprentice, and they would have sent you out an email, and it would have outlined 2 links about where you can go and enter this information. It's the same login where you would go and either attach a new apprentice to your organisation, or when you need to go and apply for those milestone payments that the apprentices need. So the way that the rebate works is every quarter you will upload the details of their wages. So they'll often want either a wage report or bank statements to verify that you've actually paid the apprentice, and then 50% of what you have paid them will be given back to you in a rebate to a maximum of $7,000 a quarter. So each quarter from the March, June and September quarter, for every apprentice, you'll get a maximum of $21,000. Now, if you are unsure about any details, then I do urge you to go and speak to your manager. You've usually got a contact person that your apprentice is accountable to, and they will be able to guide you as to where you need to go. If you haven't got that email, they'll be able to help you navigate through loading up those reports. But any reports out of your payroll software for per quarter per employee will be enough to submit your payment.
Thank you so much, Leah. That's great. The apprenticeship one starts from January, doesn't it? So you can't get JobKeeper in that first quarter. That's how you get your 9 months compared to your 6 months, isn't it? So.
Well, no, isn't JobKeeper going to be backdated to the 1st of March?
They've got to be working for you at the 1st of March, but they'll only pay you a month's in arrears at the beginning of May. So we've got so we're really going to be getting JobKeeper from the 1st of April from any payments we make. So we've got that quarter because we can get the apprenticeship discount. What is it? $7,000 for January to March, and then we'd go on to the JobKeeper. If, as you say, it's a better deal, isn't it?
Yep.
Yeah. So that's just to clarify that. Thank you, everyone, hanging in there. And Colleen Tarrant's the next speaker from our Brisbane office. She's the last speaker, so hang in there, and she's got lots of good stuff to help you keep your business going for cash flow purposes.
Thanks a lot, Julia. And this has been very topical and very hard to keep up with, as the government seems to have been changing it each day. So it's great that they've just recently changed and passed that legislation to help Australian businesses. So I'm Colleen Tarrant from the Brisbane office of Bantax, and I specialise in businesses on zero and investment property owners. And that's why I'm particularly interested in this topic, which is cash flow assistance for businesses. So in a recap, thanks Julia, so far the Australian government, and we've been talking about this, has been talking about, additional lump sum payments to employers, JobKeeper payments, payments for apprentices and trainees, instant asset write-offs and accelerated depreciation up to 150,000, and all that's really helped businesses. But how else are governments helping? Because it's not just the federal government that's supporting their businesses, it's also the state governments and the banks. And let's see how else they're helping. Yeah, so this is something that probably hasn't got a lot of press, but there's less personal financial risk. So normally, if you're a company and you're trading whilst you're insolvent, that is, you can't pay your debts, your business debts, as and when they're due, and the director, knowing that, incurs new debt. Really, a director's personal assets could be on the line. So what the government has said, that we recognise that this is a really difficult period for a lot of businesses, and they're giving businesses basically a get out of jail free card, so that businesses might appear to be insolvent, but no one's going to be having their personal assets on the line whilst they're insolvent, just for this next 6 months. And that's actually a really big concession, particularly for a lot of small businesses, where they might not actually realise how they're trading for a number of months. Maybe their bookkeeper only comes in each quarter. So no one who's in business wants to lose their house or their personal assets by trying to employ Australians. So that's actually a really good concession for a lot of businesses. Now the next one is a little more protection from being sued. So usually a business debt can be only a relatively small sum before you can get sued for it, depending on whether it's bankruptcy or insolvency in the state. But now the federal government's increased this to $20,000 for the next 6 months. So if you owe someone $5,000, they can't sue you or sue you for that amount for the next 6 months. And also, the time a debtor has to respond to being sued will increase from 21 days, which was almost unworkable for businesses, particularly in regional areas, from 21 days to 6 months. And that also is a big concession for businesses that are having difficulties. But of course, it also works the other way. If you have other businesses owing you money, that might be a sadder story just for yourself. But it will take the heat off a lot of smaller businesses. And now we come to some of the more juicier cash flow items that the federal government's offering to guarantee 50% of new unsecured loans for your business. So it's not secured against your assets or secured against your family home. It's unsecured loans, new unsecured loans for your business. So up to $250,000 for a 3-year term. And the business turnover must be under $50 million or less, which is pretty generous. It's a lot of Australian businesses. And also there's no repayments for the first 6 months. And let's all hope that the COVID-19 restrictions won't be lasting that long. So applications for that are available up to 30th of September 2020 for new finance. And there's just one thing with that. So when times were good, was your business actually making money? So if you're looking at getting one of those loans, and say you're going for a $100,000 loan or a $150,000 loan, have you worked out your forward cash flow should you take this up, or talk to your accountant about it? And probably combining this with other COVID-19 concessions, both state and federal. Because if you haven't been making money when things were good, is this extra debt really what your business needs? And maybe it is and maybe it isn't. And this will be different for each business. But if you talk to your accountant and talk to your bookkeeper, about getting some of these concessions, maybe one of these can really help you with your operations and keeping your staff on while we're all holed up in our houses. So yeah, look at your figures. Now the other thing is, and this is for a lot of people of affected businesses, a repayment holiday for affected businesses in Australia. So for 6 months to what they're saying is about 98% of affected businesses. Now, this also applies to commercial property landlords affected by COVID-19. And we know there are quite a few of those in Australia where if they've got cafes, hairdressers, beauticians, etc., they've all been heavily affected by this and then not getting any trading. So this could also help them over the next 6 months. So it's applicable if your business has loan facilities up to $10 million. So it doesn't actually reduce your loan, but it defers the payments, or they might waive some fees and charges, or they might work with you to get some debt consolidation, which would be a good thing to do for some businesses anyway. If things are a bit messy and they've got different interest rates, maybe that might help you even in good times. And, the banks aren't giving you a big present wrapped up in a nice box with a bow on the top. The interest will probably be capitalised in the meantime, depending on what you can organise with your bank. What the banks also can do, because a lot of the business owners also own their own properties, is that they can also apply to defer their home mortgage payments. So there's a lot of concessions in there, and you have to talk to your bank. And the banks on just about all the banking websites, they're all saying they've got a higher rate of people calling them and contacting them, but just keep on doing that because the bank wants to know, wants to work with you. I mean, banks don't want everyone to go bankrupt and their businesses to go insolvent. It's in their interests to work with us just the same as it's in the interests of the government and the staff and everyone in the society really to make all this work. So what the banks are saying is that your credit rating won't be affected by this measure as long as your payments were up to date prior to COVID-19. But the banks are really very willing to negotiate, and I think that's a really good thing. Where can you access this help? If you go to this website, the Australian Banking Association has got a lot more of the fine print to do with that measure and about talking to your bank and about the ways that the bank can help. And so that business relief packages have got a lot more detail about that. So that's a really good link to have a look at that if you want to talk to your bank, being a bit more informed before you actually talk to them. In Queensland, we always knew that Queensland was a perfect state, and this is a really great concession, corridor loans, which is Queensland Rural and Industry Development Authority loans. And it's a way that the state government in Queensland is helping businesses with operational and job maintenance support. So these corridor loans have an application process that's got a lot of paperwork to get together. So I've had some of my businesses apply for this, and it's good actually to apply as early as you can because applications for this loan are open only until 25th of September 2020 or until the money runs out. And I know that a lot of businesses have been applying for it. So basically what it's saying is that they will give a loan and it's got a ceiling on it which is dependent on how much in wages you've been paying in your business. But they're saying that it's going to be interest-free for 12 months and then for 2 years it will be on a really low rate of interest. And then after that, it's going up to a 10-year loan. So it's an incredibly generous concession. And I thought originally, this is great. You can combine it with the asset write-off of up to $150,000 and get a concessional loan for it as well. But it's not for purchase of assets and it's not to refinance another loan. It's for maintaining operations and it's for maintaining jobs. So it's really to help businesses stay open and employ staff. So there's a web reference in red down the bottom that's got a lot of information. It's got little videos that are easy to watch. It really explains it quite well. Basically, you need your last 2 years tax returns for your business and your last 2 years financials. And they also want personal tax returns for the directors, the working owner directors, their personal tax returns for the last 2 years. If you don't have your 2019 tax returns done, and some people don't because they may not be due until May or June this year, and in that case the government is willing to accept basically management accounts for the 2019 years. What they also want is for the owner directors to give a list of personal assets and liabilities of each owner director. So directors who aren't also owners, they're directors only, just need to provide personal ID. And they want account balances for all your business loans and credit card accounts. They want a current copy of your business activity statement account from the ATO. I found it interesting that they didn't want to see a copy of the income tax account, but they've only specifically asked for the activity statement account. They want an age list of debtors and creditors at the time of application. So your accounts really need to be up to date. I mean, that's something that Bantax always has advocated for our business people, so that they've got really up-to-date information on the financial state of their business. But you need all this information, and it shows, you know, keeping your own records is really important when you come to this sort of stuff, because the earlier you get your application in, the more likely you are to perhaps get your loan approved, because yes, the money may run out long before the 25th of September. You also need 2 items of identification for each director. If you're a trust, trading as a trust, you need a copy of the trust deed. And for not-for-profits, you need a copy of the Memorandum of Association. So there's a lot more information. There's also a good list of frequently asked questions to do with this loan. So for Queensland businesses, this should really help them keep the doors open and keep them open at a concessional rate. So the interest-free period is just amazing, really. As a form of finance, it's better than trying to rely on your credit card, building up your credit card balance for 6 months, trying to keep that going. So it's a really good thing. So the maximum loan is, yes, up to 50% of your annual wage expense to a maximum of $250,000. Remembering, of course, that you are going to have to pay it back. There's also no penalties once your business is up and running again if you want to pay it out early. So there's no exit fees for that loan. It's a very, very flexible loan, and I think it's Labor just trying to support the workforce in Queensland, which is, you know, from business owners ourselves, I think is a really good idea. So there's some of the cash benefits that you can get on top of everything else that has been discussed in the previous webinars. There's the insolvency protections, there's the protections against being sued for small amounts, there's the 50% federally guaranteed loans. You can talk to your bank, you can talk to your accountant, who are giving their clients, like our officers, a great deal of support at this time. And in Queensland, there's queried loans. But on all of these concessions, really, you need to read the fine print, because there is a lot of fine print, and it's legislation that's been produced in a very short space of time. But if you talk to your accountant, they will be up with, you know, what you need to keep your business going. And I hope a lot of Australian businesses do keep their business going and keep people employed, because that's so important for all of us in society. And that's Colleen from Bantax in Brisbane, signing off on COVID-19.
Thank you, Colleen. That was great. And that Queensland loan, you're right, amazing, isn't it?
It is.
Well, that brings us to the end of the presentation. And I want to thank you if you're still on here, staying to the end. Yes, it is a lot of information, but you need to know about it before we can help you with it, because I'm not too sure whether people have really realised just how much is out there to help you, and we're going to have to help you through it. So how do we help you through it? Don't forget that blog I mentioned at the beginning. That's available in the library section of our website, bantax.com.au. And you could sign up for our news flash, which is free, and we don't spam you or anything, and that'll give you regular updates. You follow us on Facebook. We're daily. I have no trouble coming up with a post to tell you the latest that's going on. But most importantly, you need advice on particular circumstances for you, and that means coming to one of our offices, or really these days it's all about having a Zoom meeting with us. And we do have all those facilities to do that. So for personal advice on your particular circumstances, please contact the nearest Bantax office to you, because we hope to be able to see you in person one day. But in the meantime, you can consult with us over Zoom to get into the really nitty-gritty details of this. This webinar has given us the chance to let you go straight to the things that are relevant to you. We don't have to re-explain it. We can concentrate and make the most of that. And that's $150 for half an hour discussion over Zoom. Now, the contact details for each office is on our website under the About Us page. But as you can see on this map, we're all over the place, or at least on this half of the country. And with Zoom, we can cover you anywhere anyway. So we're here to help. Thank you very much for staying till the end. And as everyone's saying now, stay safe and stay well and stay still. Bye, everybody.